Welcome to the Housing Market Podcast. Today we've got a treat. We've got Dustin Owen from the Loan Officer Podcast on. And Dustin really is a guy that has been in the business quite a while, that breaks down kind of what he sees right now, what he's hearing from originators, and what's to come in the future. And oh, by the way, how to look for and how to be a great partner in this business right now. So, the goal with this podcast is to invite you into the conversations that we're having at Keeping Current Matters about what's happening in this market. And this is a podcast that you're going to want to listen to and take notes about what Dustin says. Let's hop in. All right, Dustin, let's get started. So if somebody doesn't know you, tell folks a little bit about what you do, the Loan Officer Podcast, everything going on.
Yeah, so through and through, and I do this when I travel the country and speak, I'm a mortgage dude, right? I'm a mortgage dude. I grew up in the business. I was 24 years old when I came in as a rookie loan originator working for this IMB out of Atlanta, Georgia by the name of Home Bank.
Yeah.
And my prior sales experience was selling TV advertising. But throughout my career, I was able to kind of grow the ranks of a broke, scared, lost rookie to a top producer. Then I was a scared, lost producing branch manager. And then from there was able to grow from one branch to 5 branches, from 5 branches to an entire division,
right,
while producing loans at a high level. And this industry has been godsend to me because it has taught me so much about myself and life that I don't know if many other professions could do. And about 4 years ago, I came to a point where I hit a milestone. I was turning 40. I had sold my production to my loan partner, and I had a savings goal. And I'm like, well, I want to do something fun. And to me, hosting a radio show was fun, or it sounded fun, but getting one of the FM stations to take you on is very difficult. But podcasting, well, anyone can do that. So I started podcasting, and people would ask me, well, what's the purpose of the podcast? I'm like, besides having fun? They're like, yeah, besides having fun, what's the purpose of the podcast? I'm like, well, at the end of the day, at that time, I had 50 loan originators who worked directly for me. I had another 200 loan originators that I was more of an executive sales leader to.
Right.
And those loan originators had 1,000+ clients every single year. So I said, I'm going to make content for our loan officers, their clients, and their customers. To me, a loan officer's client is actually their referral sources, right? Realtors, builders,
right,
divorce attorneys. Their customers are the borrowers. And by doing so, I was going to create content that is essentially the stuff they don't teach us in school, right? These are the lessons I was giving to my borrowers when I was originating, the lessons I was teaching to branch managers and to loan originators who were launching their careers. And it was the things that growing up I craved, or the topics and the content I craved, but we didn't talk about it at the dinner table, or
right,
it wasn't taught to me when I was in undergrad. So we started doing it, and lo and behold, it was fun. And lo and behold, people were tuning in. And now we're fortunate that we have a podcast that has millions of downloads a year. It's allowed us to launch a YouTube channel. It's allowed us to launch a free newsletter specifically for mortgage loan originators. And then recently, we launched a MLO coaching community to where loan originators who are looking for coaching and training and want to do so from a community aspect, they can pay a couple $100 a month and come be coached and trained by me and my 5 faculty of top producers. So that's
awesome.
A little bit of a background of me.
Yeah, well, there's no doubt that you have the ear of loan officers and mortgage professionals across the country. And listen, we're recording this in the first part of May, and there's probably not a better topic for people listening right now than what's happening in the mortgage business. So let's maybe break that down just a little bit. I'd love to get your perspective on maybe, where we've been, where we're at right now, and then maybe where we're going. Certainly not from, the technical aspects, although if you want to get into that, let's do it. But how do you see this market right now? We've come out of the last few years in COVID and everybody refinancing and buying a home at 2 3/4 to now somewhere around mid-7s and people kind of going, whoa, that felt like a big shock. What do you feel like in the mortgage community? What are folks right now dealing with in sort of as you process that?
Yeah. So I would sum up the 2020s as chaos.
Yeah.
2020 and 2021 was chaos. 22 and 23 and now 24 is chaos. We don't have normalcy there. We're missing the Goldilocks era. I think the Goldilocks era is forthcoming.
Yeah. How do you define that? Yeah.
Goldilocks is everything's just right. There's just the right amount of inventory, and rates are just at a point where they're affordable, and there's just the right amount of originators and origination companies.
Right.
You know, it's a nice, healthy market. We're not dealing with the craziness of 2020 and 2021, and we're not dealing with the past 2, now going on 3 years, where if someone said, can you summarize for me the past 2 or 3 years in the mortgage and real estate market? I would tell you from experience, I think the past 2 years have been worse than living through 2008.
Wow.
2008 for me, and I think most of us in the industry, it was a knockout punch.
Sure.
And it might have been a sucker punch that came out of left field and just knocked us out. But when we came to and we dealt with what was left. Or if you want to use like a weather phenomenon, it was a Category 5 hurricane that just came through and wiped out an entire city. Now we have a chance to rebuild with whatever is left and whoever was left. Whereas the past 2, now going on 3 years, man, if you're anyone into like mixed martial arts or any type of that type of sport, it's leg kicks and kidney punches. Right. It is a slow, painful way to lose versus that knockout punch. But I'll tell you, there's business to be had. Right. People are buying homes and loan originators and real estate agents are making money. And when I study a random sample of 500, something I just did a week or 2 ago, here's what I've learned. The people who are doing really well in this market, you have your top 10 percenters. Sure. You have your top 10 percenters. They're going to be great in any market. They're wired a little bit differently, and they don't know any different except for they're going to get up every day, put on their uniform, and get to work. Whether work is easy or work is hard, it doesn't matter. They're going to put in the work. And that's something the rest of us can look up to. Right. But then you have those that came into the industry 4 years ago or less. Well, they have to get up every day and put on their uniform and get busy because they don't have any other alternative. They're still in that building phase. Additionally, they don't know really any other market. So they're doing really well. The people who aren't doing really well are those who are kind of stuck in this purgatory of, well, I'm 5+ years in the industry, but I'm not a top 10 percenter. And those are the people that find it difficult to get up every day, put on their uniform, and get busy. And therefore,
why do you think that is?
What's that?
Why do you think that is?
I don't know. You know, it's is it complacency? Is it they've never had to deal with this before? I mean, think about how many people have actually been in the industry 30+ years. We haven't seen a 22 or a 23 since probably, was it 91 and 92? Right? I mean, you have to go back that far. So if you dealt with 08, I've already made the statement on today's podcast that I think 08 was different because 08 was a knockout punch. It just came through and wiped out everybody. So many people, including me at times, I was buying into May 10th of 2023. Things were going to get better. Right. So I just had to survive to May 10th of 2023. Well, when that date came and went and things weren't better, and then we saw rates shoot up, I was still holding on to the hope that, well, the Federal Reserve is going to be lowering rates 4 to 5 times in 2024. So if I can just get through Q1 of 2024, I'm going to get a robust spring home buying season, a robust summer home buying season. Yeah. And that's going to be the reprieve. That was kind of like my finish line if I was a long distance runner and this was a marathon race. Right. Well, now here we are, just wrapped up April of 24. We're into May. It's looking like the Fed's not going to lower rates at all in 24. And now we're sitting back waiting for the labor market to break. My goal has been moved on me. So you asked me, why do I think it is that people are maybe stuck in purgatory? I think many people have just been waiting for the market to come back. Waiting for the market to come back, and it's not coming back anytime soon. I
think you bring up an interesting point, because here's and I think it's very different than 2008, but I will tell you where I think it's similar as well. Back in 08, those that were in the business lived through it, and it's kind of like, hey, if we can get to 09, we're gonna, we're gonna be okay. We got there, and we're like, okay, maybe we're not. We 6, maybe 12 more months we'll be there. At the end of that time, we're like, maybe it's not gonna happen. You know what I mean? And maybe this is all, not a good idea. But we live in a market right now that has had those sort of, false positives to say, okay, this is going to turn here and the spring market's going to be good. And now we're, halfway through the year. And in this question, a lot of the titles of different blogs and things have been the case of the disappearing rate cuts, from the Fed. And like, we're going to start out this way. And no, we're not there. So that's the reality of the world that we live in. And, I was at a conference last week, and a lot of the top producing agents that I talked to said at this time, in the year in their business, they were ahead of where they were last year.
Yeah.
But they felt like they'd already worked a full year, right? In being busy and in all the things going on. And so I find that very interesting comparatively to 2008 and where we sit today. And what do you say to the person that says, I'm there right now, whether they're a loan officer, they're an agent, they're a title rep that's going, gosh, I got to figure this out?
Well, I do think things are better this year for the sole purpose of the amount of attrition, right? I mean, we have far less people, whether you're title, whether you're realtor, whether you're lender, we have far less people, here we are in 2024, chasing the same amount of business than we did in 23. So for that, yeah, I'm seeing the same things you're seeing. I'm seeing some of my originators, they're up 20, 30, 40% year over year. Those are also the same people who've been getting after it regardless of market conditions. So I think for that, there's a survival of the fittest. There's something about being an endurance athlete.
Right.
So my advice to the people today, regardless of where you are, is, hey, continue being an endurance athlete. Understand it's not about the next 6, 12, or 18 months. It's about the next 6, 12, or 18 years.
Yeah.
And the work we put in today is the market share that we're going to gain in 25, 26, 27. And I'm in the boat. I see 25, 26, 27 as Goldilocks years. I got to survive 8, and I got to rebuild in 9, and I got to build in 10 and 11. Then we got to 12, 13, 14, 15, 16. Those were Goldilocks years. Those were years where everything was just right. I liked my business. I liked my career. I liked who I did it with. I loved the money I made. And to me, if I'm keeping my eye on the prize, it's not about the next month, the next quarter, or the next 2 quarters. It's about building something so that I'm in the position to thrive when those Goldilocks years come back around and capitalize. Because if I want to follow the patterns of history, my Goldilocks years may be only this long, at which point the cycle may start to repeat itself in some form or fashion. Yeah,
no, it's a good point. I think where we sit right now in, the rate environment creeping up after, this sort of maybe even unhealthy environment that we saw in mortgage rates, prices having gone up, a lot of talk right now about affordability. We certainly talk about that at Keeping Current Matters. And you've talked about misinformation on the cost of buying a home with the NAR settlement and everything. Talk a little bit about that, and because cost plays into the equation for many, many people right now, right?
Yeah, 100%. And that's the conundrum that we're all in. It's, someone saying, well, I'm going to wait. And I'm like, well, why are you waiting? Are you waiting because you're not ready? Well, that's a great reason to wait. If you're waiting because you think prices are going to come down,
or rates are going to come down,
right. Sure, rates very well should be coming down. And if they're not, we may be in a world of hurt. But I've never understood waiting, if you're ready, unless you're going to go and live with mom and dad or go live with your best friend and not have to pay rent, because we have to pay for housing regardless.
Right. You have a cost there.
Yes, there's a cost there. And I don't think the consumer always understands that when you're comparing your rent to your mortgage, it's not an apples to apples, because $300, $400, or $500 a month of that mortgage payment is going towards principal reduction, right? That is money that we are burying in our backyard. It's our money. We're putting in our backyard for safekeeping, and we'll have access to that money later down the road. Whereas when rent, no part of that is going towards principal or equity in our home.
Right.
I always love the argument. Someone's like, well, I'm going to have to pay for insurance. I'm like, okay, but insurance and taxes are typically rolled into your mortgage payment. So when I'm comparing your mortgage payment to your rent, I've already factored in the insurance. I've already factored in the taxes. However, when someone's talking about their rent, have they factored in renter's insurance?
Right.
Do they not have renter's insurance? Why do they not have renter's insurance? And even if that's only $600 a year or $1,000 a year, that's still an extra $50 or $80 a month that should be factored in. So waiting to purchase baffles me when someone's ready. Now, if someone looks at me and says, Dustin, I don't care if you can qualify me for $3,000 a month, I can only afford $2,500.
Right. That
is okay. You're not ready because you can't afford. So you need to go rent for $2,500 or less. That said, I would share with that person that if they're renting for $2,500, owning for $3,000 again is about the same dollar amount because of principal reduction. But for that person, we're just going to have to wait for rates to come down, but not for home prices to come down. Because what I would say is, if home prices came down by 50 grand, and I don't care what market you're in, right? Atlanta, Richmond, Nashville, Las Vegas, Reno, Orlando, where I am, $50,000. What are we talking about in terms of a monthly payment? $300, $250 bucks. Right. Now rates coming down by 1 to 1.5%. Okay, now we're talking about $600 or $700. So those people who are waiting aren't necessarily waiting for prices to come down because that's not their answer.
Right.
Their answer is, I'm waiting for financing cost to make homeownership more affordable to me.
Yeah, I think it's a great point. You know, we did we've talked a lot about this and the reality that regardless, if you live indoors, you pay a mortgage payment. You either pay it for somebody else or you pay it for yourself. Right. And you're absolutely right. Principal reduction plays into that. But the other thing that always kills that argument, because there are these arguments that, hey, it's cheaper to go out and rent an apartment where I live than to buy a home. The thing that always kills that argument is the accumulation of equity. You know, and we use the home price expectation survey to give a 5-year window. And I can tell you this, the average home bought in this country today, you earn in the next 5 years about $83,000 in equity, right? So whenever you make that math, equation, they never factor in equity, and cost. And I think it's so important to remind people of that because cost today with inflation, look, the world is more expensive today than it has been in prior years. That is a fact. Affordability in homes has been great over the last 10 years. And now we're getting into a market that's a little bit more normalized relative to that. So what's your best script right now to somebody listening that says, I'm talking to somebody and they're like, you know what, we're going to wait?
Well, I want to build on, David, what you just said. And I got out, I'm a geek. I'm a mortgage nerd. I got out my HP 12C. Okay. It sits right here. Right. And back in the day when I was hardcore originating, I owned 3 of these. Yeah. One was in my car. One was at the office.
Were you with Home Bank?
Yes.
Yeah. You mentioned Home Bank. Everybody, I feel like that was the type of company back in the day. You can still tell people that we're at Home Bank. You know what I mean? Like they looked a certain way, they acted a certain way. That was a killer company back in the day.
No, we very much have a bit of a Saban-esque coaching tree for those that are in the Southeast who A, know who Nick Saban is, and B, would know who Home Bank is if you've been around long enough. But you shared that number, $84,000.
$83,000, yep.
Right, and so you asked for a script. My script may be, look, numbers don't lie. That's why I love numbers. People lie, math don't lie. So let's just look at the math and let's be super conservative and let's even argue against David, who just told us he has data that's going to tell me if I become a homeowner over the next 5 years, I'm going to generate $84,000 of wealth through home appreciation. Okay, I'd maybe want to counter David and say, yeah, but David, I had to pay an extra $600 or $500 a month in my payment.
Right.
And we're not going to argue equity. We're not going to argue tax deductibility of mortgage interest, none of that. I'd be like, all right, cool. So that's $500 extra per month times 12. That's $6,000 a year. All right, so that $6,000 is going to eat into your 80 grand. But then you're going to say, yeah, but you know what, David? I had to spend $8,000 on home maintenance, home repair. My pool pump broke. What sprinkler head busted, whatever the case may be. And then I'm gonna look at that math and say, what was that? And when you run the math, it was still less than $80,000. Right. And then you start thinking, what about, and by the way, those are worst case, like worst case, $8,000. I don't know if you're spending $8,000 a year in home maintenance, but I used it for that example. And I don't know if your mortgage payment is truly going to be $500 more per month. But when I run that math, it was still a delta of like $15,000 in favor of home ownership. And then you start thinking about this. What did it take me to get into that home? Did I put 3% down? Did I put 5% down? So then all
Right.
of a sudden you start looking at what is my ROI on a basically, let's just call it $30,000 investment. So a $30,000 investment is still paying me how much instead of had I put it into my IRA and my 401k, or I started buying Bitcoin with it. So I would use my calculator. I would run math. I would run best case scenario math. I'd run worst case scenario math. And I would show that consumer that whichever way you cut it, home ownership, if you're ready, home ownership is still going to be, and it is the champion 70 years in a row for the number one way to generate wealth in our country.
Yeah, no doubt. It's the number one creator of wealth in the U.S. You know, it's funny you break that down. And folks, if you're listening, you can go, if you're on Instagram, you can follow KCM on Instagram. And I did a reel on that where we broke down the cost, and then I just took the added payment. Let's assume it's $300 or $500 more, on average. It's very hard to defeat that argument. You can add in everything, and your worst case is you're even. You know what I mean? In that, and that's in a far out sort of scenario. Let me ask you this, Dustin, because I think this is something that many folks in the business struggle with, but I think it's also something that some people have mastered, and that is if I'm an agent, do I have a great partner that I can link arms with, that I can sort of tell the clients that I'm working with, hey, go sit down and talk to Dustin, because you'll be better prepared as a buyer, to make an offer. Or if you're a loan officer listening, being able to have a great agent partner that you feel like you're not just, judged on every deal, or, it's sort of transactional, but having a true partnership. What would you say to people that don't have that right now?
Well, you're speaking to my heart. You're speaking my love language. You're going to wind me up, and I'm going to go a little bit now. First and foremost, partner. That word means something. Yeah. So whether it's a realtor or a lender, whichever angle you're taking this from, partner means something. And partners sit down and they talk about business. They share what's going on in life, and they have common goals, or they at least are aware of each other's goals, and they have verbally agreed to work towards those goals. So as a lender, if I'm teaching other lenders how to be great, or as a realtor, this is what great lenders should be doing for you. To me as a lender, my job is to help my clients, who are real estate agents primarily. I need to help them sell more homes, make more money, and look good while doing so. Like, that's what I have to do. Now, the how is probably most important. So how could I do that? Well, how is 3 to 5 different methods, and how is going to differ from realtor to realtor, because what matters to one client isn't necessarily what matters most to the other client. I'm going to start with this. I think a great partner sits down, discusses goals up front, sits down 6 months later, discusses where we're at with those goals, and then looks for solutions to help achieve or exceed the goal. So my first step is I want to help my realtor partners capture and close at a higher percentage. So if they're referring me the bulk of their buyers who need financing, it's standard operating procedure for me to be readily available, good at my job, and offer clean, ironclad pre-approvals. So that's the given. But what's not given is how well do I relentlessly pursue those leads to make sure that we help capture the bulk. Because here's what I found about real estate agents. They're really good in general of working with the 2 or 3 buyers who are ready today, but they tend to be less systematized to help those leads that came in today, but they won't be ready to buy for 6, 9, or 12 months. A great lender can have the systems and processes in place that help capture and close those leads. So that to me is step 1 for being a great partner. Now, step 2 is, what am I doing after the fact? Once the loan closes, what am I doing to make sure that I'm marketing myself and that real estate agent to that particular borrower or buyer, to the agent, so that I'm keeping our names, our likeness in front of them for years to come? For me, it may be I enroll them in HomeBot. For me, it may be that I relentlessly follow up and I offer annual mortgage reviews. And I make sure that after I do the annual mortgage review, I remind them that the realtor is still in the market. The realtor can still help them and people they know. And I even update the agent. And then the last thing I would do as a great lender trying to be a phenomenal partner to the real estate community, I need to help them generate leads. Now, I don't help them generate leads by paying for their Zillow. Not saying that's not a bad
Right.
approach. That's just not my approach. And it's not saying I wouldn't do it. I haven't done it. But to me, it's no. Let me teach you these loan products that I have, but not what is a DSCR loan? What is a bank statement loan? What's a 2-1 buy down? Because that would be me selling to other mortgage professionals.
Right.
No, I want to teach my agent how to take one of my products and then market it to their community that they serve to generate curiosity, to generate interest in home ownership. So it's my job to be the source of information. It's my job to bring that information to my realtor partners, but more specifically, teach them how to take that information, market it, and sell it so that the consumer reads it, hears it, and thinks, wait a minute, that applies to me. Or, oh, I didn't know that. Now that I know that, maybe the dream of homeownership is more attainable.
Yeah.
So I think those are, for me, the 3 ways that I would attack what a partnership means, whether I'm a lender and that's how I'm going to call on realtors, or if you're a realtor and you're tuning in and listening to this, to me, this is what you should be looking for in a great lending partner.
Right. Well, I think when you see it in the business, and you've been in the business long enough, and certainly people listening have, you see it, you're like, hey, that person's got it, this person doesn't, and you can tell that.
Most real estate agents know what's happening. Good agents understand what's happening. But great agents, they can explain what's happening. At Keeping Current Matters, we help real estate agents become experts. With market insights and marketing tools, you'll not only stand out, you'll thrive in any market. Keeping Current Matters. Be the expert.
You mentioned buy downs and ARMs and things like that. To combat affordability right now, how much of that are you seeing?
Not enough.
Okay.
Not enough. I mean, we got on this kick of 2-1 buy downs about 2 years ago.
Right.
And here we are in 2024. And I think what happened is December of 23 happened. December of 2023 gave us all a head fake, right?
Yeah,
That's when we're like, oh, rates are coming down.
Yeah, we're going to be
back
good.
into the 6s. And
explain to people what a 2-1 buy down is for somebody listening that may not know, so that if there is an agent listening that says, hey, I need to have a conversation with my partner about that to help somebody, achieve the dream of home ownership right now, what that is.
Cool. It is a introductory interest rate that lowers the consumer's rate of interest for the first year by 2%. That's the 2 part of the 2-1. Then in year 2, it lowers their interest rate by 1%. And then by year 3, the interest rate's going to be what it was when the loan originator or the lender locked it in. So to give you an example, let's just say today's rate's 7.25. Well, at 7.25, the buyer, whether they qualify or not, they're balking at the payment. But what if we could allow that buyer to ease into the payment? So I'm going to give the buyer a 5.25 interest rate in the first 12 months. So the first 12 payments are going to be roughly $600 cheaper per month. And then starting month 13, now their interest rate's going to go up from 5.25 in this example to 6.25. Now, 6.25, their payment is $300 higher than what it was last year, but still $300 lower than what it would have been had I just locked them in at a 7.25 the day that they bought the house.
Right.
Now, starting on month 25, now they're making the payment as if it was 7.25%. Well, what we know and what we can hypothesize based on economic data is the odds are in the consumer's favor that in the next 12 to 24 months, we should see interest rates somewhere in the 5.5 to 6.25 ballpark range. So by the time that buy down has worked itself through, the consumer more than likely is going to refinance into a lower long-term rate. Or, most consumers, we have life events. Those life events allow us to earn more money. And that life event allowed me to actually ease into that payment that maybe I qualified for, but I wasn't comfortable. But if I could start it at $2,400 per month, year 2, it goes to $2,700 per month. Year 3, I'm at $3,000 per month. Even if mortgage interest rates didn't go down and I wasn't able to refinance, maybe that was what it took in order for me to ease into the comfort of home ownership. And the caveat is, think about what rent's going to do.
Right.
Rent, if someone's renting today at $2,500 a month, it's not going to be $2,500 a month more than likely next year. And
Right.
insurance tag isn't going to be $2,500 a month. So rent's going to be increasing. Therefore, it's common for housing costs to increase. Why wouldn't it be common for their mortgage payment to increase? And then once it hits that $3,000 a month in this example, that's when it would basically flatline or
Right.
top off.
And I think your point of, certainly somebody needs, we're not saying buy something you can't afford.
Correct.
But it does look like we'll be in a better rate environment. What does it cost to do that?
Yeah, the cost to do that, and typically this is where the seller has to step in. I'm glad you asked that question because to me, understanding what a 2-1 buy down is fine and being able to speak the lingo is fine, but how do we sell it?
Yeah.
To me, that's what's most important. How do I use this product to generate greater interest in home ownership?
Because it can be more advantageous too for a seller, even in a price reduction.
Correct, 100%. So the cost roughly is going to be 2 to 3% of the loan amount.
Right.
Okay. So, and it's typically the seller paying it. So let's use a $300,000 loan amount for this example. So let's say the cost is going to be $6,000 to $9,000, but $6,000 to $9,000 in terms of affordability to the consumer, meaning this, the seller has two choices. They can lower their sales price by 10 grand, or they can offer a 2-1 buy down to any home buyer who's buying their house. Well, if they offer 10 grand off of the sales price, that's going to lower someone's payment by $60 a month. If they offer to pay for a 2-1 buy down, all of a sudden that's lowering someone's payment by roughly $500 or $600 in year one and $200 to $300 in year two. So the cost, let's just call it 10 grand on average, 2 to 3% of the loan amount. But the strategy is a seller being able to advertise to the consumer, buy this house and I will subsidize your interest rate for the first 2 years.
Yeah.
Now, not every consumer knows the word subsidize. So maybe it's buy this home and receive a drastically reduced interest rate for your first 2 years. Seller will pay.
Right.
I think and the strategy to the listing agent is going to your seller and say, look, we don't need to drop the sales price $20,000, $30,000, $40,000. We
Right.
can actually move this property just by offering, let's just call it a 3% seller contribution towards closing costs in order to help the consumer make their payment more affordable.
Right. Well, I appreciate you breaking that down because it seemed like, a year and a half ago, everybody was like, all right, we're going to do this. You talk about the head fake of the end of last year. And now this is a topic that I think probably needs a little bit more attention in today's market, being that we are in an interest rate environment where price is still very, very high.
Well, and think about this. I don't know if enough originators are teaching the real estate community the advantages of getting creative with mortgage insurance. So those home buyers who are putting 3, 5, 10, 15% down that are paying monthly mortgage insurance, you don't have to pay monthly mortgage insurance. So if I wanted to make my listing more attractive, or if I wanted to make homeownership more affordable, and I have a buyer buying my property, or I'm a lender and I'm financing someone buying a property, why not try to originate a loan with 5% down and no monthly mortgage insurance? Because that mortgage insurance could be $200 or $300 a month. Well, I can use a seller credit to pay for mortgage insurance as a one-time upfront premium.
Right.
And not enough consumers know that exists. Not enough originators know that exists. And sure as heck, not enough real estate agents know that exists. And if you can become that creative or that savvy, you're really serving the greater good of the community, because the goal of us in the industry is to make homeownership affordable, to make homeownership available, and then to make homeownership affordable, getting creative with 2-1 buy downs or getting creative with mortgage insurance, utilizing seller credits to offset the cost to do some of this. I think that is our solution. I think it's something we're going to have to lean harder into the next 12 months.
Yeah, I agree. And I think, listen, I'm thinking right now, I'm like, if you're a loan officer listening to this, figuring out how to get in front of agents and help them with this.
Oh, 1,000%.
Go sit down with an office and say, here's what we can do with a 2-1 buy down. Here's what we can do. Here are products that we have. Here are ideas around mortgage insurance, because it then arms the agents to be able to have those conversations with folks that are thinking about buying, and certainly refer them and sit down and have a conversation. Or if you're an agent or a team leader that's listening to this podcast, find a great loan officer to help equip your agents, because that's going to be the difference maker. I believe that.
I agree 1,000%. I'm thinking of the word partner again. Great partners offer solutions, but great partners also solve for pain points.
Right.
Another pain point is, hey, these homes aren't moving in this particular community. Okay, why are they not moving? Well, they're not moving because they're 20 years outdated, and I can't get a consumer to come in and pay us, full price for it. Okay, work with a lender who has some kind of a renovation loan, and then now all of a sudden market that home, call out the deficiencies, but then offer a solution to the consumer. Design the home of your dreams, and then you market it that way. Buy this home and customize it with this particular type of financing with as little as 3 or 3.5% down. I think as an originator, we need to stop talking to other originators, which is what we tend to do, and start talking to the consumer, or start talking to the consumer's advocate, which is the real estate agent, and solve for pain and solve for and offer solutions to where we can make homeownership more available and homeownership more affordable.
Totally. I agree with you 1,000%. So let's talk about, we're middle of the year right now. I want you to get out the crystal ball and let's talk a little bit about what's ahead. What do you see for the remainder of this year? You talked about 25 and 26 just a minute ago, but kind of break down where we're at and what you sort of feel like the rest of this year is going to bring.
Well, do I want people to like me or not like me? That's
my first. We want the truth.
The truth. You can't handle the truth. The good news is none of us know the truth. And if I had a crystal ball, I'd be on my yacht in Fiji. I would maybe still be doing this call with David, but I don't know how often I make myself readily available to coach and train loan originators. But no, here are my thoughts. I think that the industry, let's call it housing industry, real estate, mortgage, title, all the industry, all the companies and services that support housing, I think we're due another 10 to 20% reduction in force. So that's coming. It's going to be a slow attrition, but I do think we'll see a couple more large independent mortgage banks forced into merger and acquisition.
Can I pause for a second and ask you a question about that? How many loan officers do you know the numbers on what that looks like in the loan officer community right now?
So I know various numbers, and I've heard numbers that were in there. There's 200,000 licensed mortgage loan originators. I've heard there's 90,000. So I don't know who gets their data from where.
Yeah.
And I don't have a good pulse on it. When I run my numbers, I run it as we're at 120,000 at the peak. We're at 90,000 today, and we're probably on our way down to 75,000.
Gotcha.
Okay. And that's an individual licensed full-time MLO. I think the reason why there's varying numbers is certain companies report originators who are actually producing loans and originators who are licensed. I think there was like over 200,000 that were licensed, but only like 120 that had done a loan in the past 6 months.
Right, and that makes sense because anybody that derives compensation off of that is licensed, and they may not be an originator. I don't know yet or if it is happening, if we're seeing that in the agent community. I don't have the numbers right here in front of me.
Yeah, I've seen that they are. I mean, especially when you looked at December, how many people were renewing versus not renewing. Mm-hmm. So the agent community is definitely seeing, I don't know the numbers as well as I know the lending community, but overall, when I speak about lending, there's a lot of lenders, many of us, who anticipated a reprieve coming in Q2, Q3, and it's not coming.
Yeah.
And you can look at the data coming out of the Mortgage Bankers Association. Last year, the average mortgage lender lost $1,000 per loan that they funded. Think about that. You would have made more money not doing loans.
Yeah.
So that's not healthy. That is cannibalistic. That is a race to the bottom. And there's plenty that thought they had enough runway, they had enough money in the coffers, they could sell off enough assets to backfill those losses, but they did so some a year ago because they were waiting for May 10th. And when May 10th didn't happen, That's when we saw those forced mergers, those forced acquisitions. And by the way, y'all, these were fire sales. These weren't, oh, I was a tech startup. I built this wonderful company and some hedge fund just bought me for a 10x multiple. No, this was, oh my gosh, my company's going under. Let me sell what I have so I can, if I'm the owner, take my chips off the table and go home with something intact before I bleed out all the money I do have in the company. So I do believe, and I'm hypothesizing, that we still have 2 or 3 more big events like that, and that those would be announced. I'm seeing it. I'm seeing that there's originators that are good originators who had lots of promise in this industry, and for whatever reason that they're not going to make it. And it's sad for them, but for those of us that are left, it's a good thing, because we're marching towards those Goldilocks years where maybe it's Goldilocks plus. Maybe there's this much business and this many of us that are chasing it, where that's phenomenal. That to me was 14, 15, and 16. I would love to have 3 years like that again. I do see once we get past the election that I don't believe the labor market, and I have not believed the labor market is as strong as it's reported to be. And as we see unemployment go up to 4.25, 4.5 even, the Fed's going to jump in. The Fed's already talking about like backing off of their quantitative tightening.
Right.
And the labor market breaks. We see mortgage rates go from 7.25 back down to 5.75. We've seen already, and I'm seeing it in Florida, inventory is building up. Now it's not building up a la 07, 08, 09. It's building up to healthy numbers.
Why
4
is
months,
that?
5 months, 6
Why is
months.
inventory in Florida building up? Because it's one of the markets that is seeing inventory rise.
Yeah. Florida and Texas are definitely those markets that are seeing inventory rise. Some of it's due to new construction. Like up in the Northeast, there's not as much new construction because there's not as much land in Rhode Island and New Hampshire that is in Florida and Texas. So you have new construction, but you also have insurance costs, right? Like we used to be the most affordable state. Not only did we have good weather, but we had really affordable housing. Well, when insurance goes from $1,200 to $3,600, from $3,600 to $6,000, that impacts housing. And by the way, it impacts housing for renters too, because it's going up in the landlords.
They pass that savings right along, right?
Yeah, they pass that, correct. They pass those costs right along. And then you also have demand. I mean, we're still a state that is in demand. So what we are seeing is our inventory is stacking up. It doesn't concern me yet. In fact, it kind of excites me because I like operating in a normalized market. I don't like buyers having the upper hand or sellers having the upper hand.
Right.
I like things to be a nice, even, again, going back to my term, Goldilocks. So we're seeing that, but in my golden ball, not my crystal ball, I think we're in a really different, nice market by the time we get to March or April of next year. Unfortunately,
by the spring market's what you're saying.
Yes, but unfortunately, we're going to have to get to the spring market, and I don't see much breaking until post-election. But post-election, I think when it breaks, it may be a snap. And along the way, we're going to have some casualties because we're going to have some guys and girls. If we're endurance athletes, they're going to cramp, they're going to pass out, they're going to dehydrate, they're not going to be able to finish the race. But for those of us that do finish the race, that party on the other end, it's going to be a fun party. It's going to be a party that you're going to want to be a part of.
I hear that. So you're talking about the spring market. We get there. You said it may snap. I think you mean snap in a good way, right?
Yeah, I think something's got to give. Snap in a good way for those of us in real estate and housing. Snap in a good way for those that are looking to purchase a home.
Right.
I don't know if snap in a good way is good for the rest of the American populace. You know, like here we are sitting on the sidelines. We're cheering for more unemployment.
Well, this is the position we get ourselves into where for some scenarios, bad news is good news and good news is bad news.
Mm-hmm. Yeah. And this is, look, if you study our industry, with the exception of one time, 07, 08, real estate, housing is what pulls us out of a recession.
Right.
And I'm not saying we're going to go into a recession. The Fed's doing their damnedest to do that soft landing. I think it's going to be a bumpy landing, but I'm not an economist.
Let me tell you something. It's interesting you bring this up because I last night I got an email from our HOA. And it was for the board meeting, which I don't ever go. But they said this. They said the architectural review committee had seen a dramatic decrease in the number of people that had put in petitions to do whatever to their home. And I'm like, there's an interesting sign right there relative to the economy.
Talk to your neighbors, talk to your friends. Who do you know at that dinner party that's raving about how well their company is doing, or the promotion they're going to get, or the big fat bonus they got, or the hiring frenzy that their company is on? I mean, I have a buddy who's a top recruiter in the country.
Yeah.
And he recruits for 5 or 6 different industries. And we had lunch about 9 months ago. He's like, I mean, his words, bro, it's dried up.
Yeah.
So when that happens, that'll be great for mortgage rates. That'll be really good for housing affordability. That will then unlock those people with the lock-in effect, right? Those sellers who want to sell, but they don't want to get rid of the 3.5% rate for a 7.5% rate.
I think psychologically in the 5s, they're probably like, okay.
Yes. Yes. So, but it stinks as a human, as someone who cares about other, people. Yeah, you're cheering on bad employment data, right? People losing their jobs, companies not hiring. But when I say break, snap, that's the snap I'm talking about.
And listen, nobody wants that. I mean, nobody wants that casualty income. Listen, a recession typically has been good for the mortgage business and the real estate business. We don't want that. That means that businesses are impacted and all that, that comes along with it. But I appreciate you breaking that down. Yeah. So as we wrap up here, I think you've given really a good, perspective to folks on partners, on what's happening in the business. Is there anything that you're passionate about that we missed that you say, hey, David, we didn't talk about this?
I mean, look, I'm passionate about this industry.
Yeah.
I mean, my podcast, the Loan Officer Podcast, is literally the stuff they don't teach us in school. I'm passionate about teaching. I'm passionate about inviting people into the room where it happens. And for me, that's everything that has to do with wealth generation. It could be real estate investing, property flipping. It could be budgeting. It could be saving for retirement, or it could be how to start my own business and how to sell and market better. I mean, those are things I'm passionate about, but people who want to hear me talk more about that, I'm like, look, tune into Spotify or Apple, or better yet, go to our YouTube channel, because that's the podcast plus so much more.
Yeah.
And then I love coaching and teaching the next gen mortgage loan originators. So people who are in the mortgage space that are looking for coaching and training, like check out what we're doing over at tloponline.com, because I'd love to introduce you to myself and my faculty if you're looking for some coaching and training. But
I'd say do it. Go listen to the Loan Officer Podcast. Dustin, it's been amazing to get a chance to spend a few minutes together and just talk about what's going on. I'm grateful for you joining.
David, I appreciate the opportunity. And by the way, if you're not a member of Bridge Builders, if you're not tuning into KCM, the way that we got connected is because I have been a fan of KCM, of Bridge Builders, for the past decade. I've been a user. I teach loan officers how to leverage your content in order to be a better partner to the real estate community.
Right.
So if you're tuning in for the first time, or you're not yet in that ecosystem, make sure you're doing it. Yeah,
for sure. People listening, they're like, what's Bridge Builders? I know KCM, but not Bridge Builders. That is our offering for loan officers and folks in the mortgage community. Really, the intent was to build the bridge between great agents and great loan officers, because we believe that's what wins in the market. The educated agent working with the professional mortgage advisor, the client wins. That is the best possible scenario.
Yeah, and loan officers, I said it earlier, it's our job to be the source of information, right? And you don't have to be the source, meaning you went and did the research. No, spend a little money, invest in your business, join Bridge Builders, and let them curate the information, and then you can then share it, because your best time is probably spent going on the next sales call, not doing 4 hours of research and then drafting digestible content for the real estate agent and the consumer.
Yeah, absolutely. Well, Dustin, thank you. I have to have you on again, and I've thoroughly enjoyed our time together.
I look forward to it, David. Thank you.
Gosh, I enjoyed that conversation. It was fun to get to know Dustin and spend a few minutes with him talking about this market. And I believe what I said there at the end, the educated agent working with the educated loan officer, the professional advisor wins in this market. It wins for the client. And, at Keeping Current Matters, we believe every family should feel confident when buying and selling a home. And that is our goal with everything that we do, and certainly with the House and Market podcast. So if you like this, share it with somebody that needs to hear it, maybe with a partner of yours. Subscribe if you're not subscribed, and we'll see you back next week.